Well, good evening, ladies and gentlemen. Good afternoon. For some of you that may be on the West Coast and are just joining us at 3 o'clock Pacific time, I should say. Apologize for that. Welcome to part two of our power options strategy discussion, focusing on collars. We focused last week on the variety of collars that can be used, and tonight we're going to focus on some of the management concepts and management principles for a collar after you've gotten into the position. Now, we're going to have to go through a lot of information this evening. I'm going to try to keep it quick, but without speaking too fast, so everyone can hear me and everyone can follow along. I am going to try to leave time at the end to handle your questions. And what I'm going to ask is that you leave your questions until the end of the presentation. Okay, so if you have questions about a certain principle or certain concept, you can go ahead and send that in, but I probably won't actually get to address that until the end of the presentation. So just let me know if you have any questions. I'll try to leave some time at the end. Okay? Now, I'm not going to go into a whole description of what is power options. Most of you joined us last week for part one, so you got a description of the power options tools, what is power options, and why we're here. I'll introduce myself verbally, but I don't have a slide for that. My name is Michael Chupka. I am the Director of Education here at Power Options. I've had the great fortune to work with Ernie and Greg Zerenner for the past 7 years. Ernie did create Power Options 12 years ago, essentially as a suite of tools to trade his own personal accounts. After a month or so of having that up on the web, he received a couple hundred emails from individual investors asking how they could subscribe to the service because at that time they had never seen anything like it. Okay, so that's just a general introduction. We did most of that at the beginning of the last presentation, so we're going to skip over all of that. Okay, so let's talk about managing a collar spread. Now, as we learned last week, of course, collar spreads in all their various forms still allow you to have a limited risk but also a limited gain scenario. They can be managed and adjusted to earn higher returns or reduce risk depending on the direction that the stock has moved once a collar spread has been opened. Now, the management depends solely on your continued outlook for the underlying stock, what you think is going to happen next. I know that's difficult and that, we don't have a crystal ball. Nothing's etched in stone. There's no way to really tell what's going to happen to a stock next, which, by the way, we discussed last week. That's one of the main underlying reasons why we're using this type of strategy, because we don't know the future. We don't necessarily want to get stuck in a covered call position where the stock drops 33% and blows through a potential stop loss without having protection in place. Now, key rule of all investing is that sometimes no management is management. If you try to micromanage any position, whether it be a collar spread, whether it's a covered call, whether it's a naked put, or even a calendar spread, if you try to make too many adjustments too often, you're going to end up either paying a lot in commissions, a lot in unnecessary commissions, or sustaining potential losses because you made the move too soon and then the stock just quickly snapped back in the direction you would have been better off leaving yourself where you were. So sometimes no management is management. Okay, so last week what we went over briefly, let's go over a little review. Let's talk about the standard long collar form. Now remember, a collar in its pure form is a long collar, I should say, in its pure form is any combination of buying stock, selling a call, and buying a put. Whether your put is further out in time or in the same expiration month as the call that you sold, whether the short call is above the put strike price, whether the short call is below the put strike price, any combination of buying stock, selling call, or buying a put is a collar, is a long collar, okay? The most common form is what's referred to as a standard collar, and that's what we're going to look at first. We're going to look at some scenarios with a standard collar form and some adjustments we can make. Remember the specifics of a standard collar. We'll buy stock. Let's say we buy shares of stock at $50 per share. We might sell the 1 month out at or out of the money call. Let's say I buy a stock at 50. I might sell the 50 call or sell the 52.5 call just as I would in a covered call trade. But at the same time, of course, we're going to buy an out of the money put with the same expiration month. So if I was entering a position now, let's say I buy a stock at $49 per share, sell a November 50 call, and at the same time buy a November 47.5 put option, I might still be able to make a possible 2 or 3% return if I'm assigned, meaning the stock goes above my short call strike price. and I'm assigned at November expiration, but I may not be risking more than 6 or 7% depending on the cost of the put and how that works out. Of course, the standard long collar, it looks like a profit and loss chart of a bull put credit spread. We compared that last week, the parity trade. Our sentiment is we're going to expect the stock to rise over the next 30 to 50 days, 30 to 60 days. The maximum profit is earned when the stock is above the call strike price. We let ourselves get assigned. The profit can be achieved if the stock is between the strike prices, if the stock hasn't dropped more than the amount we collected from the premium between selling the call and buying the put. Our losses are limited if the stock has a major decline, even if it has a 30 or 40% drop. That put gives us the right to sell to close our shares of stock at that strike price. Even if the stock was trading at 38, we could still sell to close it at 47.5. We're expecting a slight increase in the stock price over that period of time. We're not expecting a major gain. If you're expecting a major gain due to an event such as a earnings event or some kind of news that you're expecting to come out, you might want to play a different strategy to take advantage of that. Just be careful with speculating because we all know how that can get us into trouble. Okay, so what are the possibilities? After we've entered a long collar, standard long collar, what are the possibilities? Again, the stock's trading above the call strike at expiration. Our put expires. The stock is assigned. We make the maximum profit. If the stock is between the two strike prices, in our example, if it's between $50 and 47.5, well, the call and put expire, and we still have the stock. This could be a profit or it could be a small loss depending on the initial break-even price, okay? And then if the stock is trading below the put strike price in a standard collar, well, the call expires worthless. We can exercise the put and take the maximum loss, all right? Well, let's look at possibility number one a little bit more in depth. We've entered into a collar position. The stock has moved up above the strike price. We might be close to expiration, okay? Well, the first thing we can do is let the stock be assigned. This allows us to earn the maximum profit. Now remember what we reviewed last week. When we set up the positions, we set up the criteria in the Power Options search screen, we were putting in positions that matched what we wanted to see. You know, we were looking for positions where the percent of assigned might be at least 3 or 4% or higher, and where the maximum risk was no greater than 7%. Okay? So the stock moves up, it's above my call strike price, I can let it be assigned, I'm happy. I found a position, I opened a position that matched the potential return I wanted to see. Okay? Now, I can also let the stock be assigned and reload into a new collar on the same stock. So the stock's moved up above my strike price, put expires, I let it get assigned, I still like the stock, I can buy back into the whole position at the current stock price, sell now a next month out call and another next month out of the money put, or I can take the capital and the profit I made and move into a new position that matches my criteria. All right? Okay, we could roll the short call, move up the put strike price, but we would do this, of course, as we get close to expiration. We can buy to close the call, sell a new call at a higher strike price, and either sell to close the current put or just let it expire and then buy to open a new put that's the additional month out in time. So this is going to depend on what we think is going to happen next. Okay, if we're expecting the stock to continue to move up, we might want to roll the position. If we think that the stock we're done with the stock, we got the return that we wanted, we're going to move into another position, we'll just let it get assigned, take our profits, and go into another position. Okay, let's take a look at an example. Let's say on September 21st, this was the day after September expiration, we ran the smart search and we came across Newmont Mining. Okay, the Newmont Mining was currently trading at $44.40 per share. So I'm going to buy 100 shares of Newmont Mining, NEM, at $44.40 per share. This was on September 21st. At the same time, we're going to sell an October 46 call for $1.50, and we're going to buy an October 42 put for 95 cents. Okay? So we make a little bit of net credit there. We take in a net credit of about 55 cents or so. The maximum profit, remember that occurs if the stock's trading above $46 per share, on October expiration would be $2.15 or 4.9%, and the maximum risk if the stock dropped below 42 would be $1.85 or 4.2%. Well, here we are a day before October expiration, and Newmont is currently trading at $46.56. Well, what are some of the management techniques we can do? Well, let's take a look now. Let's transfer out of the little slide presentation here. let's go over to Power Options and take a look at the portfolio tools. And here you see we have our Newmont mining spreads entered. Excuse me, ladies and gentlemen. We have the Newmont mining spreads entered. I have two of the same collar that we were just looking at, okay? The second collar listed. Here is our open position as we just outlined for September 21st, okay? We bought the stock at $44.40, sold that 46 call for $1.50, bought the 42 put for 95 cents. Okay, I do have it entered in here twice. Right now, as we mentioned, our stock is trading above $46.56 per share. If we leave it alone to expiration on Friday, we're going to get assigned and earn that maximum 4.9% return that we just saw. Okay, let's just take a look briefly at the profit and loss chart before we look at some of the management techniques on this particular position now that the stock has moved above our strike price. Okay, from the Power Options portfolio tool, one simple click. Let me just go ahead and open up the profit and loss chart. You can just see this graphically, okay? Here's our position. Here's the current stock price in green. Okay, you see we're above our call strike price right here. So we're going to get assigned on the position. If we do, we're going to earn that 4.9%, okay? So if that's what makes us happy, we can just go ahead and let it get assigned. But if we wanted to adjust the position, let's say our sentiment now is that we feel that Newmont Mining is going to continue to move up in price. Instead of letting this call get assigned right now, let's look at some opportunities of rolling to a higher strike price. The stock's at $46.56. Let's use the tools on Power Options. We're going to go into the analysis page. And let's take a look at some of the potential profits if we roll the call first, okay? So we saw a little bit of this last week when we linked to the position analysis tool from a trade we have open in the Power Options portfolio. We get an original breakdown of that position. There's our profit and loss chart again. We were able to quickly compare the current liquidation gain and loss right here. So if we liquidated the whole thing right now, that is another choice. We could liquidate the entire position right now, buy to close the call, sell to close the stock, and just sell to close the put for 5 cents or whatever it's available. If we liquidated the position right now, we'd make 4.4%. However, if we leave it open for the next day and a half, once whatever remaining time value is gone, we let ourselves get assigned, we'll achieve a slightly higher return of 4.9%, basically about $20 because we're only doing 100 shares on this position, okay? Now, what I want to do is let's scroll down a little bit further. And here we see some potential rollout opportunities, okay? And on Power Options, it's going to spell out for you. Here's our position. We can buy back that original October 46 call for 79 cents. We're a little bit less than 80 cents in the money. There's still some time value remaining on it, okay? The stock's currently at 46.56. So depending on what I think is going to happen next, I have the opportunity to potentially roll. I could buy to close my 46 call for 79 cents. And now sell to open the November 47 call at $2.27 per share. Okay, now what is this going to do to my position? Well, it's going to give me a new net credit. Remember, we collected $1.50 originally on this call. We're going to have to buy it back for 79 cents. Now we're going to roll to a different strike price and collect $2.27. Okay, now we're shown that if we get assigned now, if the stock keeps moving up in November expiration, we get assigned, we can potentially turn this 4.9% gain into a 10.9% gain, okay? And if the stock remains the same, if it remains at around $46.56 per share, there's our percent if unchanged. Now, I could also roll if I wanted to see more appreciation. Let me move the arrow there. There we go. If I want to see more appreciation, I could potentially roll to the November 48. Now, this gives me a lower call premium. I'd only collect $1.85 for selling the November 48, but if it continues to move up above that price, I might now lock into a 12.2% return if Newmont continues above $48 per share. Okay, again, notice how these terms I'm leaving you with, you can see how this is dependent on what you think is going to happen next. Okay? Now, if I wanted to, we know what would happen if we got assigned. We'd make that 4.9% return. The put would expire worthless. Let's say I wanted to do the first step of rolling the position. I want to move the call up because I want to try to lock in a higher gain. and let's just move one strike up. Okay, let's just go to the 47. But before I do that, what I'm going to take a look at is simulating the trade. Okay, let's see what this trade looks like. So from that position, that rollout opportunity, here I'm shown my original position over in the red corner. This is our original Newmont mining, our current percentage return of 4.4%, and our maximum return if the stock's assigned at 4.9%. Okay? Now over here on the right, on the blue side, it's showing me that we can roll now to this new position, and let's just move underneath and take a look at the chart. So this gives us a new graphical interpretation of what our profit and loss chart would look like. Here is the red line shows us the original collar position, okay, getting assigned at that price. Now what this new line is showing us is what this rollout would look like what this rollout would look like at October expiration. This just shows us that we can increase a little bit of the profits further up as the stock continues to go, but we know what the hockey stick graph would look like, where we're going to adjust it to. Okay, so let's say I wanted to go ahead and roll this position. Let me scroll down below the chart, and we see here that here's that current call. It shows me my buyback cost over here on the right and what I could collect for the new call. Well, I want to go ahead and submit this change to the portfolio. I'm going to roll the call up because I'm expecting a higher gain. So I'm going to go ahead and click on Submit Change to Portfolio. All right, great. So now you see we still have 3 collar positions. We're going to get to the other 2 in a minute. One's actually called a custom spread. Now why is that called a custom spread? The reason why is because we just looked at the short call. And I did that for a specific example. What I would do is I would never just analyze this by saying, oh, I'm just going to roll the short call and then not care about what the call does. I don't do that personally. I do have some investors who will do that, and let me step backwards for a minute and explain what I mean. We had a collar spread. We entered a new position in Newmont Mining. We put on a collar where we had a potential 4.9% if assigned with a maximum risk of 4.4%. Maybe we did that because we liked Newmont Mining at the onset. We thought it might move up over time, but we were a little bit hesitant in the market. We were a little bit concerned due to implied volatility or other features, okay? So I have some investors I talk to, power options customers I had talked to on a regular basis, who will start a position when they're first opening a new position that they're neutral to bullish on over 3, 4, 5 months. They'll open it as a collar, but after the first month, if the stock has shown them a positive trend, instead of keeping it as a collar going month by month, they might just turn it into a covered call. They might only roll this call as we just did. We rolled up to the 47.5 call now, or 47 call now, excuse me, in order to continue to generate income and potentially lock in a higher profit, because we feel comfortable now that the trend has solidified itself and we're comfortable the stock's going to continue to move up in price, okay? But this is called a custom spread now because what haven't I done? Well, technically here I have a long stock position with a short call that's out to November and a put that's still expiring in October. Haven't adjusted a put yet. And I did a big no-no, but I did it on purpose to sort of teach a lesson. I would never analyze this collar position rolling it if I'm keeping into a collar strategy just by looking at the call. I have to look at both together. So for argument's sake, what I'm going to do now is simply roll this put, okay? And it's a simple one-click transactions. I'm going to go ahead, go to Position Actions, and I'm going to select Roll Leg from that particular put option. Okay? So now it gives me, we just started off with the November 42. We're going to go ahead and sell to close that for the minimal premium. It's actually listed at 0. It has a 0 bid listed right now because it hasn't traded in several days. Okay? But what I'm going to do here is just keep it at the same strike price. Even though I moved the call up 1 strike, I'm going to go ahead and keep the put where it is at the November 42 put strike. Okay, and now this shows me that it's going to cost me 87 cents per share. Let's assume that we got 5 cents at least for selling that call. I'm sorry, selling to close the put. Let's adjust that, okay? So I'm going to go ahead and put that in and just submit. Now we're going to go back to the normal portfolio. We're back to 3 collars. And let me just highlight our November position. Okay, so we've maneuvered the position. We rolled the call up, and we kept the put at the same strike price. Now, I expect this to increase my original risk. I'm expecting now to have a risk higher than 4.4%. The reason why? Because I didn't adjust the put option. I left it at 42. Let's take a look at that profit and loss chart and see what we did. What did we really do with this position, okay? Well, actually, we did a good thing, didn't we? We lowered the potential risk to only 2.3% of our entire cost basis. Here's our original stock price, okay? And we kept in the premiums of what we received. But now you can see that after we rolled the position, we've increased our maximum profit up to $400 or 9.3% if we get assigned at $47, okay? At the same time, we managed to lower our risk to only $100 per share or 2.3%. Okay, so that's one way. Once the stock has moved above the strike price of your call, you can go ahead and what we just did there is we discussed letting it get assigned, taking the 4.9%, or step 2 is roll both positions. Now, why did I choose the 47 over the 48? Why didn't I look at the 49? Why did I leave the put? That's all going to depend on a few factors. What you think the stock's going to do next, what risk you're willing to take on the position. If you can lower your risk, that's great. If you increase your risk, you want to make sure that it still matches your threshold. And in addition to that, what new increase in return you're looking for. Okay? Now, preemptively, what could I have done to stop this from happening? Okay? We looked at a position that I opened on September 21st. The stock has moved up above this price, and it was trading at $46.56. It was already above the call strike price, and we have 1 day left to expiration. What could I have done differently if, let's say, the stock had moved up to $46.56 a week or two after I had opened the position? Well, some things that I like to do, let me go back. I'm going to close out this profit and loss chart. Remember, I had entered in this position twice, okay? I'd entered in this standard collar twice, all right? So what I'm going to do now is go back to the profit and loss chart for the original Newmont mining position. And I just want to take a look. Even though we see here that highlighted in green, this green line here, this shows where the current stock price is. It's already above our call strike price, so we're risking assignment. One thing that some collar investors will do, and I do this myself, is I may look. I had an email come in. Let me start this way. I had an email come in today from Frank, who I think is joining us tonight. And about a half hour before the session, he wanted to know, what can I do preemptively to avoid this kind of situation? You know, if the stock starts to move up, what can I do to avoid it? Well, I kind of treat this in some cases like a bear call credit spread. If I'm in a standard collar and I'm thinking now that after I've opened the position that the stock might continue to move up in price, okay, one thing I can do is set a contingent order or a stop order to buy to close my short call if the stock reaches within 1 or 1.5% of my short call strike price. And what I mean by that is I've sold the 46 call on Newmont Mining. As the stock starts to move up, 1% of that 46 would be 46 cents. So I might have put in a contingent order with my broker or put in a stop to alert me in power options or put in a mental stop to buy to close the short call or look to buy to close that short call if the stock had reached, let's say, $45.54 per share, within 1% of that $46 strike price. This allows me to close it now, and if the stock continued to move up after I closed the position, I'm still holding the put. I still have my protection in place, so as the stock moves up, I can wait for it to move further before potentially selling that 47 or 48 call. If I wait a little bit longer and the stock continues to trend, I can get a better premium. Okay, so that's one of the preemptive positions that you can do, one of the preemptive ideas that you can do once you enter a collar. So you can use a contingent order to buy to close the short call if the stock reaches within 1 or 1.5% of your short call strike price. Manage it before it goes in the money. If it's trading right at the money, it might cost you some time premium. If you still have 3 or 4, let's say, weeks left, some of you who are familiar with the radioactive trading methodology knows that one of Kurt Frankenberg's ideas that he focuses on is the at-the-money bell curve. The premiums swell when the stock moves up to or down to a particular strike price. The time value is going to swell. So if I wait, it's true, when the stock moves up and it approaches 46, when it's trading on 46, that's going to have the highest time premium it'll ever have on that particular date. Okay? As it goes deeper in the money, we'll have more intrinsic value, we'll have less time premium. As it's out of the money, we'll still have lower time premium than if it's at the money. Okay, but that's one suggestion that you can do to close this preemptively as the stock reaches your strike price. I'm not going to talk about the downside yet because we're going to go through a couple more examples, right? Naturally, we just looked at some management techniques of what happens if the stock moves above our call strike price as we get closer to expiration. Now, let me change this first. Let me go back to the slides. Now what we want to review is what are some things that can happen if the stock is trading between the strike prices at expiration. Okay, so we've opened a position. We opened a collar back again on September 21st. We'll go through the example in just a moment. But over the last 30 days, the stock ended up trading between the call and the put strike prices. Well, what can we do? Well, number one, we just let both the put and the call expire worthless. Depending where our break-even price was, this may result in a small gain or a small loss, okay, depending on where the stock is between the strike prices and what our break-even was. After I let the call and the put expire worthless, I can reload the position as we just saw. And what do I mean by reload? Well, I originally sold, let's say, a 50 strike and bought a 47.5. Sold a 50 strike call, bought a 47.5 put. They both expire because the stock's still trading at $49. Well, now, what am I going to do? If it matches my requirement, I'm going to sell the November 50 call, and at the same time, buy the November 47.5. I'm going to reload the collar, rebracket the stock. One thing that I mentioned in the last example, once the stock has shown us a trend, has continued to move up, remember we opened a collar potentially because we thought the stock was a good stock long term, but we were afraid in that first month. We were a little bit hesitant because of what might happen in the next couple of weeks. So we used a collar to protect ourselves. Well, in that last example, once we saw the trend, when we roll the call and we roll it to a higher strike price, maybe we just let the put expire, and I mentioned just turning it into a covered call now because we feel more comfortable with the trend. If the stock is one of these ones that's between the strike prices, it's dangerous to just use a covered call. The stock hasn't shown you any trend yet. It hasn't moved significantly from when you first opened it. So if you just do a covered call now without that put in place, that drop that you were afraid of might happen the next month when you don't have any protection and you could get affected by the position. Okay? Now, in one of these scenarios, in some of these scenarios, if I've opened a collar, the stock did not show me any movement, it stayed between the call and the put expire worthless, let's say I have a small gain. It could only be a gain of 10 cents, 15 cents per share, maybe even 20 cents per share. If I'm not comfortable now with the stock moving up, it's okay to close the position and move on. My call and put expire worthless. I'll sell to close the stock now. Maybe I just made enough profit to cover my commission costs in the particular position, but that's okay. The stock has not shown me any positive trend. Thankfully, it didn't show us any negative trend either. We didn't get any positive trend out of that collar position. So it's okay. Don't try to force yourself to keep trading it if it's not showing you anything. If it's just stagnating there and it's not moving, don't be afraid to just close the position and move into something else. One thing that you're going to notice that happens, if you're trading a collar, the stock stays between the two strike prices. Some of you out there, most of you out there should know this, but what's going to happen after a month or two of the stock just stagnating and staying at around the same price? Well, the implied volatility and the volatility is going to drop. So what's that going to mean? That original 4.5% return we potentially made in the first month, or 4.5% risk that we had because the call premium we received, that's going to start to dry up. Once the volatility and the implied volatility on the calls and the puts start to drop because the stock's staying right at the same price, we're not going to be able to see those same returns. So is it worth it to stay in it? After 2 months with the stock staying at the same price, if all you can do is potentially make a 2.5% return, still keep a reasonable risk of only 4%, is that 2.5% potential return still match your requirements, still match your investing goals? If it doesn't, don't keep forcing yourself into that trade. Take the small loss. Okay, if it's a small loss, if it's a 0.1, 0.3, 0.4% loss, take the small loss. That's fine. Okay, don't try to force yourself to keep forcing a trade to try to make a profit if it's not showing you a good trend. All right. Second trading example, again, September 21st, the Monday after September expiration, HSBC Holdings. Okay, could have bought 100 shares of HBC at $58.50 per share. At the same time, we could have sold the October 60 call for $1.50. and bought the October 55 put for around 80 cents per share. The maximum profit, again, which only occurs if the stock's trading above our short call strike price and we get assigned, will be $2.20 or 3.8%. The maximum risk if the stock plummeted, dropped below 55, well, that'd be $2.80 or 4.8%. HBC is currently at $58.12 per share, $58.12 per share. So both our call and our put are going to expire worthless. All right, let's link back over to the tools here. Let's take a look at what we've got. Here's that Newmont mining. I'm going to switch portfolios, and we're going to pull up the standard collar between the strikes. And here we have our HSBC positions. Now you notice there is something a little bit different here than what we saw on the other position, on our Newmont mining position. Over here on the far right, I have these fields highlighted. The alert columns have been highlighted. Now, I could have put in a preemptive management to look to roll the position if the stock dropped more than 4 or 5%. Okay, but what I decided, what this is showing me is that originally we sold the Newmont 60 call. Let's take the middle collar here. Here's our collar for the October 60 and the October 55. Okay, we sold the call for 150. It has now dropped in price down to 5 cents. So what this show is showing me, why this is highlighted, it's letting me know that I've made more than 80% of my expected call premium. Okay? If you talk to any covered call investor, naked put traders, even calendar spread traders, what they'll tell you is they'll look to maneuver the call or look to maneuver their short option if they've made at least 80% of their expected profits, sort of the 80-20 rule. If I've made 80% of what the premium I expected to make, that's when I might want to take action. This is another type of rollout that you might consider, another preemptive management you might want to consider. I didn't mention it in the last slide because those calls had not dropped in price. But here we have a call position where we've made at least 80% of what we expected to make. So if I'm in a collar position and the stock does not move, and my call premium drops. Let's say I sold this call for $1, and 2 weeks before expiration, I can buy it back for 15 or 20 cents. I might consider rolling the position at that time because I've made about 80% of the premium I expected to make on the short position. Okay, so that's a preemptive rule number 2. But if the stock has moved up, you won't have that chance because the intrinsic value countered the time value decay. All right. So what did we discuss when the stock's between? Well, the first choice. Let me go ahead and erase those drawings there. Remember, the first choice we talked about was just letting everything expire. Okay? So let me go ahead and do that. I'm going to go ahead and show you an example of we're just going to quickly run through the scenario of expiring worthless. Now, to do that, all I have to do is on each leg manually, I'll go to Position Actions, and I'll click on Expire Leg. This is going to expire the short call for me. Okay? So we're assuming we're the day after October expiration. Now what am I left with? I'm left with those 2 collars that we're going to show different examples on, and I'm left with 1 married put. Well, we're going to let the put expire as well, aren't we? Okay, so I'm going to go to Position Actions, and I'm going to go to Expire Leg. There we go. Position Actions, and Expire Leg. And now what am I going to be left with? Well, we're going to be left with 1 long stock of HSBC. Now, as you can see, including the effective cost per share, we still have a kind of a small, we will have a small gain on this position. And let me show you what I mean. Okay, here's our long stock. We let the positions expire worthless. Again, what I'm going to do is click that More Information button. I'm going to go to Position Actions and then Position Analysis. Now this is going to show me some potential rollout opportunities that I could create. Okay, and here's our long stock position. The current stock price is at $58.12. Based on the history, we know we have a little loss there, a little gain on the position down here at the bottom. See, historically we're shown that we have a $32 gain or 0.5% from the premium we received from the call. Okay? Now this shows me a covered call opportunity, but it didn't build for me the reload position for the collar. Okay? For whatever reason, there might have not been any volume on the put or volume on the call, and that's okay, because what we're going to do is we're going to build it manually and make some adjustments if we want to. So let's close that down. We're going to link from this simple long stock position to our profit and loss chart. Okay, so let's go to Position Actions again. I'm sorry about that. I'm sorry, we're going to do it from the original collar. That's why we're going to go back to the original collar, and we're going to go ahead and do that there. All right? So the new cost basis after we let everything expire is $57.80. Let's remember that. So let's go to position actions here from this link and profit and loss chart. This pulls up the full collar for us. Okay? What I'm going to do is scroll up to the top, and we're going to go ahead and clear out those two legs. Okay? So now that's empty. Remember, after they expired, our new cost basis on this position was $57.80. Okay? So that's a long stock position that we have. Remember when we opened this, we opened it with the November 60 call and the 55 strike put. So what we're going to do is simply use this view options field, and I'm going to open the November options, and I'm going to go ahead and add the 60 call for about $1.40. Oh, and look at this. This is a very high premium here, so this probably wouldn't match what I wanted to see. But we're going to add it anyway. Okay, we're going to reload the position based on how we originally started. We're going to sell this call for $140 and buy this put at the natural ask of $125. Okay, so when I click those two links, it filled into the positions for me. Let's sell our call. Just do one contract each. I'm not going to fill in the prices. It's going to fill in naturally for the natural bid and the natural ask. All right, and then as I scroll down the bottom, what have I done? I see I have a new collar position for the next month now. Okay, remember our cost basis had dropped to $57.80 based on the premium we received from the call and what we paid for the put. Now we see that our new position, we collected a small premium now, but our new position, if the stock moves up above 60 for November, we can make a potential return of 4.1% or $2.35 per share. We're risking about $2.65 or 4.6%. Personally, this matches my personal risk-reward tolerance of what I would do for the next month out. I would be a little skittish right now because HBC has not shown me any positive trend. But if that matches, this requirement matches my goals, that right now I could potentially make another 4.1%, and I'm only risking 4.6% on the position, I did manage to lower my initial cost basis by about 30 or 40 cents initially by letting the call and put expire. This would give me a new range, a new position that matches my risk-reward threshold. I might be very comfortable with that. Okay, so now if I wanted to track this, I like this, I'm simply going to add it in as a new position here. I'm just going to click Add to Portfolio up at the top. We're going to put it in that standard collar between strikes position. That's where our HBC position was. So I click the radio button there and highlight it, and then I'll just go ahead and click Insert. Copied over all the information for me. All I'd have to do is put in the commission fees if I wanted to record that, and I'll just hit Submit. So after I've built that position in the custom spread tool off the profit and loss chart and added it, I now have that new collar back into the field. Okay, let's see that there. Let me give you a little highlight there. So there's our November 60 55 put. Okay, so again, just a quick recap. The stock's trading between the strike prices has not shown you a good trend, so you can let both the call and the put expire worthless, then reload the position, re-enter the position for the next month out if it matches your risk-reward tolerance. Use that custom spread tool to run those what-if scenarios first. Or you can simply liquidate it. If we had a small gain here, we're not comfortable anymore, let the call and put expire worthless and sell to close the stock, or buy to close them right before expiration. We haven't seen any positive trends, so just liquidate the position now, take the capital we still have, and move into another position. That's one of the great things about these protective strategies, isn't it? Whether we're doing the radioactive trading form of married put, for example, or we're doing standard married puts, or we're doing standard collar forms, we have protection in place so that we're pretty much safe there. We can preserve most of our capital to keep trading even if the stock drops. All right? Speaking of which, what do you think we need to take a look at next? Let's go ahead and run our next scenario. All right? Possibility number 3, standard collar form. Remember, we bought stock, sold an at or slightly out of the money call option for the next month, bought an out of the money put option. Okay, now possibility number 3, the stock has dropped below the put strike price. Okay, well, what can we do in this scenario? Well, the call is going to expire worthless. We don't want to really spend 5-10 cents to buy it back, but we can because, again, we've made that 80% rule again. Okay, and since we're right near expiration, there's not a lot of time value left in that put, so we can exercise the put. This results in the maximum loss for the position. We were wrong, took our medicine, said, okay, I risked that, lost that 4.5%, but you know what? When I opened the position, that's what I was comfortable with, okay? We do this. We're not expecting the stock to recover. It's dropped 10, 15, 20%. We don't expect it to come back anytime soon, okay? Now, another choice, if we do expect the stock to move up, again, we can let the call expire just like we showed, but now the put has intrinsic value, all right? So now we can sell to close the put, get that intrinsic value back since the stock's trading below our put strike price. We still hold the stock, but now we can reload the collar. We would only do this if we felt that the stock was going to recover. All right? Okay, so let's look at our trading example for this next position. September 21st again, we were looking at Aetna. Aetna was currently trading at $31 per share on September 21st. I shouldn't say currently. It was trading at $31 per share on September 21st. At that time, we could have sold to open the October 32 call at $1.20 per share, and at the same time bought to open the October 29 strike put at 70 cents per share. Okay. Now, what's interesting about this, we're we generated about 50 cents of net credit. The maximum profit is $1.50. Remember, that happens when the stock's trading above $32 per share. We'd get assigned and make 4.9%. Just like the RIM position we saw last week, this is one of those neat ones where it works out that the maximum risk is equal to the maximum gain. So if the stock dropped below $29 per share, we're only risking $1.50 or 4.9%. Now, Aetna is currently trading at $25.72, so that is well below that put strike price, okay? So we have a significant loss on this position. Now let me just clean some of this up real quick. Hold on one second, okay? All right, so let's go back and take a look at this in the Power Options tools, okay? There's our between strike positions for HBC. Let's take a look at the standard collar now that we're trading below the put, okay? Let's highlight our original position. Here is Aetna. Bought it at $31 per share, sold the 32 call for $1.20, and at this, there we go. Okay, sorry about that, guys. At the same time, bought it the 29 put for 70 cents. Now the stock has dipped below our price, and again we see this highlighted field in the alerts column because we've gained 80% on that call. Now, Orlando asked a quick question. I just want to address this. We're looking at the Power Options tools, and let's focus on this $1.20 we collected on the call. It shows you now in red that the call option has dropped $1.15. Well, Orlando's question was, why is that showing red? Isn't it a gain? This is just showing you the premium gain and loss, not relative to if the option is short or long. What we show over here in the current price is 5 cents, so we have a gain of $1.15, $115, because we sold it for $1.20. But we have a gain of $1.15 on the call because we sold it. That worked in our favor. We've made that 95.8%. This column here, Orlando, for the issue price and the total change, that's just a pure premium. That has nothing to do with whether you're short or long the option. Over on the right in the current price and this, more important, this gain or loss field, that's what's showing you the gain or loss if you've been short or long the position. Okay? Now, as we can also see, we've made $115 on the call. We're long the put, which has moved up from $7.30 to $3.20, so we've also gained $250 on the put. Hey, that looks pretty good, right? The put gained value, our call gained value in our favor, but what's the problem? We've lost $528 on the stock itself, okay? So before we move any further there, okay, let's scroll over to the right. We're going to take a look at this liquidation gain and loss. We know what essentially that's going to look like. Here we have a loss currently of about 5.3% if we liquidate the position, or 4.9% of our expected value. Okay, so remember, by looking at the profit and loss chart, if we let these two expire, if we let this expire and sell to close the stock, we'd end up with that maximum risk. Okay, but let's run the scenario of, let's go ahead and expire the 32 call here, the October 32 call, and one thing we can think of, depending on what we think is going to happen next, we mentioned reloading the position, reloading the collar, but we might not be able to get anything. probably not going to be able to get anything, I should say, for a November 32 call, are we? Because the stock's trading at 25. So in addition to reloading here, now that the stock is dropped, we're going to have to lower the position to see what we can get, okay? And what we're going to do to emphasize that is we're actually going to go into, I should say, the search by symbol tool. Oh, that was interesting, Mike. That was a silly maneuver. Let me get into the other strategies tab real quick. I apologize. Let me reload this. There we go. Okay. What I'm going to do is go into the collar spread for Aetna. And I'm going to look at the search by symbol tool, and we're going to see what opportunities are available just with the standard return by putting on, I should say, a November collar, okay, with the stock now at 25.72. Okay, well, here's some examples that look similar. Again, since the stock has dropped, that should have been November. I apologize. That's a little bit better. Okay, so here's some of our standard positions of what we kind of looked at before. With the stock at 25.72, we have the risk-reward of selling the November 26 call and buying the November 40 put. We'd receive a net premium of 45 cents here, which gives us a maximum risk just on this position of 5%, or 2.9% if we're assigned. That's not really high. If we go lower to November 26 to the November 23, we pay less for the put option, okay, but now we have a maximum risk of 7.7%, or a potential percent if assigned of 4.3%. Does this risk match your personal risk-reward tolerance? Well, it doesn't for me. But what are we really leaving out? Well, this is just if I enter the position today. We have a much different position because we can still get some value back out of our put option, can't we? Okay, so let's go ahead and do that. I'm going to simulate what this new position would look like if I just roll the leg right now. Okay, if I just sold to close the put for the current premium of 320, what would our new position look like? Okay, so once I could close the leg, it's going to sell to close it for me for 320. Let's go ahead and hit submit, and it's going to show us we're still left basically with that leftover covered call. Our cost basis now has dropped down to 28.50, but we still have a significant loss, don't we? Because the stock's now at 25.72. Okay, let me go ahead now, and I'm going to expire this call. Okay, we're going to go ahead and expire that leg. I hit submit, and now we see that we're left with an effective cost per share on the position. What's our new effective cost per share? Well, it's 27.30. Okay, that gave us some pretty good protection, but we're still down. We still have an unrealized loss to that 4.7%. Okay, so let's take a look at what this position would look like reloaded. Again, I'm going to link over from the standard portfolio, the other collar position we opened that's a similar position, and we're just going to tweak the numbers here, okay? So I'm going to clear out that call and clear out that put, and now what we see is that the stock itself, remember we changed our effective cost basis down to 27.30 per share, okay? So I'm going to go ahead and enter Aetna at 27.30 per share. Now let's go ahead and see what that collar we were looking at for November would look like now with the stock at 25, but our cost basis at 27.30. Right away, we can see the problem, can't we? But let's go ahead and build it anyway. Remember, we were talking about selling that November 26 call for $1.50. That's the call that I'm going to sell, okay? So I clicked on it. It automatically put it into this field. I changed the action to sell. We're just going to do one contract at the natural bid price of $1.50. Now, we were also looking at potentially doing the 24 strike put at first, okay? And when I put in the 24 strike put, we're going to leave that as a buy. This is going to mimic buying it at the natural ask price of $1.05. Okay, so we're going to make about 45 cents of net credit. Now that I've entered that into the new columns, let's submit this position and see what our new Aetna collar would look like with a cost basis of 27.30 and a new premium. Well, that doesn't look good at all, does it? We would never do this. Why not? Well, we can't ever get back above the break even. Okay? There's no way we can get back above the break even. Now, this seems like a simple adjustment. Why am I going through these various steps and showing this profit and loss chart? The reason why is because I know too many customers who have just looked at a position without analyzing it, without running what-if scenarios, without looking at the profit and loss chart, who said, oh, well, the stock has dropped. Let me close my put. Let my call expire. I have a cost basis of 27.30, and the stock's at 25. So let me build off of the 25 position, the $25. I'll sell the out-of-the-money 26 and buy the out-of-the-money 24. Well, that doesn't help you. What happens if now the stock comes back as you originally thought it was? What happens if this now starts to show a bullish trend? Well, if the stock moves back above 26, you're locking yourself into a guaranteed loss of 3.2%. At the same time, if the stock continues this disastrous trend and continues to drop down below $24 per share, you have a risk of 10.6%. Okay? So you always want to run the scenario. Would I do this roll? Absolutely not. I might actually, in this scenario, I might have just let the call expire, liquidated my position, taken the original risk that I had, admitted that I was wrong. Yes, it was a 5% loss, but admitted that I was wrong, and now try to move into a more solid position. I'm not going to try to catch a falling knife. I'm not going to continue to roll down this position. Some of you might be asking, well, can you do anything elaborate now that the stock has dropped? Could we maybe trade some bear call credit spreads against this stock? Could we do just buying puts and speculating that it's going to drop down? Well, sure. But what good's it going to do you? If you're still long the stock and you do a bear call credit spread without any protection at the bottom, you're trying to catch a falling knife. If this thing keeps dropping, sure, you made 40 or 50 cents on the bear call credit spread, but you've got 100 shares of long stock there that are just continuing to decline. You're still going to have a significant loss in the position, okay? And what I mentioned about buying a put, well, if I buy a put here for protection to stop the bleeding, that's great. But if the stock continues to move down, depending on where I buy my put, I might be able to make some adjustments on it. I might be able to maneuver it depending on where I buy that new put. But just buying a put thinking the stock's going to continue to fall while still continuing to own the stock is not a good move. The stock's countering whatever you're making on the put there, right? So unless you went into a long-term married put position, such as a radioactive trading profit machine, where you have that risk set up and you're making those adjustments based on the income methods, just buying a put now that the stock has dropped, it will stop further bleeding. But if you don't think the stock's going to come back, you're better just getting out of the whole position, taking your loss, admitting that you were wrong, and then trying to find something else to get into. Okay? So that's what we want to look at when the stock has declined in price. Okay? Now, let me just clear out some things here just real quick. Okay, I'm sorry, that's what I wanted to do there. Let me go back into the slide presentation. We talked last week. I'm going to do this briefly. We're probably going to go over time, and I apologize for that. We're going to talk a little bit briefly about some of the other forms we discussed last week. And what I'll do is just talk about the two main positions. If the stock's moved above our call strike price, what do we do? And if it's dropped below. Last week when we addressed the extended collars, we talked about how instead of just buying the simple 1 month out of the money put, if I was expecting a much longer term gain in the stock, I could buy a 6 month out put that was maybe out of the money or maybe in the money. Okay, I'd really probably want it to be more in the money for greater protection there. But at the same time, we can do that because when we go out further out in time, it's not 6 times the cost, right? Okay, so options that are 6 months out in time, we don't pay 6 times the cost. Last week we were looking at the RIM example. The November 65 put was at 235. The March 65 put was only 665. So we gained 4 times the time, but we didn't pay 4 times the cost, okay? And one of the rules of options trading is when we're selling, we always want to sell short term. And it gives us a better annualized return over time. And when we're buying, we want to buy long term, okay? So, you know, we still have those same similar possibilities. Stock is above the strike price. Even if I bought the stock at 49 again, sold a call at 50, but bought a 6 month out put option, okay, at an out-of-the-money strike price, we still have the 3 same scenarios effectively. Stock could be above the call strike price. It could be at or between the call and the put strike price, or it could be below the put strike price, okay? Now, with the stock above the call strike price, we could let it get assigned and keep holding the put, okay? Because remember, we were long term. So why would I do that? Why would I go ahead and let myself get assigned but hold the put? Well, it could be 2 things. One, if I'm expecting a pullback after I get assigned on the collar position initially, if the stock drops, I might be able to make a little bit more money on the put. Another reason is because sometimes if you let the stock get assigned in that first month, when you had a short-term 1-month out call and you had a longer-term put option that's 6 months out, it might be better off to let yourself get assigned and then just buy back into the stock and then sell a new call against it. You know, even though the stock's at a higher price, that was sort of countered by the premium you received by the call initially. Okay, so depending on the cost basis, that might be okay to do. Okay, you can roll the call, of course, and leave the put in place. Simple procedure, just what we would do with a covered call. I don't want to get assigned because I think the stock's going to continue to move up. I'm still comfortable with the level of protection I already have in place. I'm trying to lock in further gains, so leave the put alone and roll the call. In some situations, if there has been an increase in implied volatility, if there has been a certain adjustment in the stock, what you might also be able to do is roll the call and actually move the put up in price. Okay, depending on the difference in the strike prices between the puts, you might be able to adjust that put to lock in a further gain. Okay, let's go back to a similar example that we saw. We're going to go back to the standard collar above the call, but you're going to see that I have a different position in here. Okay, what is the different position I have? Here's that Newmont mining position that we were looking at earlier, again opened on September 21st, but in this scenario, we bought the stock, sold the same call as before, that 46 October call for $1.40, but now we bought the March 42 put for $4.20. Okay, let's take a look at that profit and loss chart, see what it looks like for us, okay? I'm going to go ahead and open up the profit and loss chart there on Power Options Portfolio Tool. And here we see the gain and loss. Kind of looks a lot like a calendar call spread, doesn't it? That's essentially what this is. It's a synthetic calendar call spread. Okay, so what we talked about last week, what did we remember from these other forms? Well, when you do these time spreads, when you set the put out further than the call, the return, the 4.7%, this is the maximum return we can make if the stock's trading right at the short-term strike price at expiration. Okay, the maximum risk on the position, well, we had 10.8% maximum risk. That might be a little bit higher than we want to go, but remember, we would potentially do this because we're looking for a longer-term gain on the stock. Again, as we talked last week, the method of doing this type of collar is not as conservative. If you really think there's going to be a long-term gain on a stock, this is not as conservative as following some of the radioactive trading methods that are just shown by Kurt Frankenberg, and we'll show you a little bit about that in a few moments, okay? So we talked about our opportunities. What is the first thing I can do? Well, let's go to that position analysis field and view some of our rollout opportunities, okay? All right, there's our original position. I'm just going to scroll down. There's our profit and loss chart again. We can look at our current liquidation values, and this is pretty neat. Okay, so we can see that right now for this long-term position, our current liquidation value, is 3.7%. That's pretty decent. The stock's moved up, so we can buy to close the call, sell to close the stock, and sell to close the put. Well, wait, why isn't the put expiring? The stock's above it. We still have 5 months to go. Remember, we bought a March put option. We still have value remaining in that put due to the time premium. Okay? So, okay, and we see if we hold it to expiration, once the other further time value decays out of that call, we might make 4.3%. Okay? Well, we talked about rolling the call based on what we expected. This is the same scenario that we saw with the first position. Here's our October 46 call in Newmont Mining. Again, depending on what we think is going to happen in November, we could sell the November 47 call or the November 48. We're showing the premium we could receive. Okay, the potential percent if assigned, this is essentially the max return now for both call, put, and stock if the stock's trading right at our expected strike price at expiration. Okay, would be roughly 8.3% if we roll to the 47 or 8.9%. And if the stock remains unchanged, okay, between now and November expiration, we might generate a 5% or 4% gain depending. Okay, so let's take a look at that. What am I going to do? Let me simulate this trade first. Let's just take a look, okay? So over here on the right, we're shown that the current return is 3.7%, or if the stock dropped a little bit, it stayed right at $46 on October expiration by tomorrow, we could make 4.7%. So let's just say roughly we've got about a 4% return. By moving the call and keeping the put in place, we lower our maximum risk from 10.8% originally. Remember, we had at 10.8%. We can lower our maximum risk down to 8% or adjust our percentage return to 5.2%. Now, I'll be honest again, remember, that's the maximum percentage return if the stock's trading right at $47 on November expiration. And again, we can take a look at the before and after picture. Here's the current position, and here's the new position of what we'd expect to see right now if we rolled to it. That's not at November expiration of the short call. That's if we roll to it right now, what would our current gain and loss be? So we have a higher potential gain on the upside. As we saw, we increased it from about 4 to about 5%, and we are going to lower our maximum risk. So if I wanted to go ahead and simulate this trade, I'm sorry, we just simulated the trade. I'm going to go ahead and perform this roll. I can do it with one click. We're going to buy that call back for 79 cents, sell to open the 47 call now for 227. Let's go ahead and submit that change. We're going to be taken back into our portfolio, and we still have our caller position. Here's our November 45 with our March 42 put. Okay, now what we can do is go ahead and take a look at that profit and loss chart. Let's see where we stand at November expiration real quick. Okay, there we go. The maximum return right about here, about 309 or 6.7%. By the way, this is lower than that 8% that the Simulate Trade feature showed. I should have mentioned that was going to happen. It was because I included commissions into this position, but that was not shown in the Simulate Trade feature we just looked at. But it is included here for my initial position. So that difference there on only 100 shares, of course, is due to the commission factor. Okay? Now, we had talked earlier about rolling the put up. That's something else we can do. We can simulate that as well. Okay, let me go ahead and close this. We just want to show what the profit and loss chart is. Let's go back to that position analysis now that we've rolled the call. Okay? And let's take a look. We had the deep out of the money 42 put. Let's see if we have anything. Yes, we do. Okay? The stock has now moved up in price. We're shown that we can sell to close our existing put for 305, that March 42 we bought, and now we can potentially open the March 43 put for 360. Okay? Now what's that doesn't sound right. Well, what would happen there? Well, since we're not in the money with a put, this is not something you would particularly do unless you thought you could really generate some good income out of this. What I mean by that is if I had an in-the-money put, a put option that was above the strike price, doing this roll by selling to close your current put and rolling to a higher strike price makes a lot of sense because what you're gaining in potential guaranteed return is the difference in strike prices. So if I sold this call for, sold the put for 305 now, bought the March 43 for 360, I'm paying a debit of 60 cents, but I'm guaranteed, I have locked in a protection of $1 higher. But we're bullish. The stock's been showing us a trend. So this might give us a little bit more protection on the position, but at the same time, I'm not really expecting the stock to fall down. Okay, we do show that this lowers our risk down to 6.9%. Rolling to the 44 put would lower our risk down to 5.5%. I could even roll up now to the 45 put for March for 4.5%. Okay, so if you wanted to simulate one of those trades again, we could just go ahead and do that. We'll click that More Information button again, click Simulate the Trade, run your what-if scenarios, look at your differences. Okay, here's our 8% risk that we just lowered by rolling the call, and now we can lower this down to about 5.5%. Okay, and then there's our percentage return. We're actually going to, if we rolled the put now, we'd lower our percentage return to 7.7% from the 5.5, and that's shown. There's our current position, okay, and here's the new position. What's significant about the new position, there are two things that are significant. Number one, if I maneuver the put up to a higher strike price, I'm going to decrease my maximum profit. But at the same time, look at the downside. The blue line and the red line cross over, so I'm actually lessening my risk slightly if I expected it to retrace. Okay? So that's just one of the concepts. All right. Okay? So let me go back to the slides here. We're not going to go through the other examples that we had of maneuvering the position when you have a far out put, when the stock has stays between the strike prices, or if it drops down below the put strike price. Okay? If you guys want to talk about that later, feel free to give me a call, send me an email. I'll show you some of the slides, and I might do a write-up for everyone based on that information. Okay? We discussed a little bit about the preemptive management. Okay? Remember the first thing I said is if I'm in the collar, if I'm expecting it to go up and get assigned, hey, that's great. It moves above my short call strike price. I get assigned. I earn the maximum return, remember, in the standard collar. Okay, and I might do other things there if I'm in one of those different long collars where the put is further out in time, whether the put's in the money or the put is out of the money. Okay, but a preemptive way of getting out of the position is using a stop, putting a stop at, let's say, within 1 or 1.5% of your short call strike price. Okay, so remember, if we had sold the 50 call on the position, I might want to put in a contingent order with my broker or look to roll the call if the stock moves up to $49.50 per share. Preemptively do it before it goes too deep in the money. Now, is that going to protect you against a gap? And I think that's one of the questions that Frank had asked me in his email. No, it's not going to protect you against the gap. Remember, one of the reasons we're using collar spreads, especially around an earnings season, is that we might be afraid that any bad news or any sudden news that comes out on the stock might cause the stock to drop 30, 40, or 50%. Well, if I have a contingent order in place to buy to close my short call, let's say at 50, if the stock reaches 49.50, if the stock closes at 49 and some really good news come out the next day and the stock springs up to $55 or $56 per share, well, my contingent order on the upside got violated. I'm not going to be able to buy the call back now for a reasonable price. Okay, it might cost me $6, $7, $8 to buy to close that call. I might as well just let it get assigned. Oh, I'm sorry. Okay, in the example that we saw, if the stock was between the two strike prices in that standard long caller form, or if the stock has dropped, another popular preemptive management technique is to roll the call. If the stock, roll your call or roll your short premium if the premium has dropped 80% of what you originally received, if you've made 80% of what you originally collected, okay? In the case of HBC, where the stock was between the two strike prices, that call lost a lot of premium. We could roll it out right now and still make about $115 of the $120 we expected to make. In the case of the other position, the Aetna position where the stock really tanked, sure, we could buy that call back very cheaply right now or just let it expire, okay? When I'm looking at an adjustment as the stocks move, let's say the stock continues to move up and I'm going to roll the call, we showed you how you can move the put up in strike price, but you want to analyze that very deeply, okay? I personally tend not to adjust the put that often. Now let me clarify something. Many of you have joined me on several webinars where I was joined with Kurt Frankenberg from Radioactive Trading. When I'm in a radioactive trade, using the 10 income methods, I will adjust the put because that's a different trade. In a standard collar, where both my call and my put were at or out of the money, and I have the same expiration month, if I'm adjusting the call, I may or may not I probably won't adjust the put. I may be looking just to take it into a covered call position now that it's shown me a positive trend. Okay, but if I'm fearing a pullback, I will adjust the put. It all depends, again, on your view of the stock and your personal risk threshold. Okay? Again, all of the information that was discussed tonight is in that Protective Options Strategies book. It's only about $19.95. It's loaded with info. It was written by Ernie Zareno, the president of Power Options, and myself. So if you want some of the further details on using those Power Options tools that we showed tonight, or some of the discussions of when to roll the standard collar or some of the other forms, it's all located in that book. Okay? If you're more conservative and you're looking more for a stronger protective trading methodology, you want to check out some of the free information at radioactivetrading.com and the discussion by Kurt Frankenberg on his radioactive trading method. Okay, the blueprint, the book that describes his full trading method and his 10 incomes, is $289 plus shipping. But you can join us every Tuesday and Thursday at noon Eastern time for free webinars. He gives away a lot of information about his methodology. If you have stocks that you think are poised for growth over the long term and you will want to take single-digit risks, this is the method that does it. Okay, this is the one you want to go with, and the 10 different income methods there allow you to make adjustments to lower the risk on the position, bulletproof the position, and move further on. Okay, for those of you who have questions on the Power Options subscription, we have a few levels. The 20-minute delayed service, again, $60 per month or $600 for the year, discounted annual rate. We do offer a real-time service, which is $79.90 per month, about $80 per month or $800 for the year. Historical data is not included with those two subscription levels, but you can add historical data for a quarterly period. It's at $99.95. Or you can upgrade to that professional level of service. That includes everything on the real-time service plus unlimited access to the historical data. The historical search by symbol tool and the historical smart history Excel tool. And that's $99.99 per month or $1,000 per year. Okay, I apologize for going over. Okay, and I'm going to field some questions, but I'm going to leave this slide up while I'm looking at a couple questions, just so you can email me at any time, or you can give us a call during market hours if you have any questions. Uder asks the question, have you ever compared portfolios of bull call spreads versus same strike? Or backtesting them since you have historical data? Well, Uder, no, I really haven't. You know why? Because review what we talked about last week. Remember when we talked about last week how if I'm opening a standard collar position, before I enter that standard collar position, after I've done my research and analysis, made sure it matched my risk-reward tolerance, what am I going to do? I'm going to compare it to that parity trade of either the bull put credit spread or the bull call debit spread. If I can make a higher return potentially with the bull call debit spread, which is a parity trade of a standard collar, I probably traded the bull call. Okay? If for whatever reason between the call and the put disparity between the different strike prices gives me a better, not return percentage either. Now remember, I'm not talking about percentage. I'm talking about premium. Okay? This was all discussed in that first presentation, the strategy discussion part 1. Okay? But if I can make more of a profit with just the collar, monetary profit with the collar, I'm going to stay with the collar. So why haven't I compared the two portfolios if I entered every position with a bull call or each position I've traded over the last 8 months as a standard collar? Because I'm already doing that before I enter the position. Okay? They're going to be just about the same. Okay, Uder, you asked another question. Does the book cover a more active, aggressive collar management strategy where puts are rolled up? It does discuss that a little bit. And more stock is bought if puts are rolled down. I think we did mention about averaging down and the risks in averaging down. We didn't go too in depth of a lot of historical proofs of why that works and why that doesn't work. It's kind of obvious why that works and why that doesn't work. But there is a whole section, a whole chapter in the back of the chapter 7, I think it is, in that Protective Options Strategies book that discusses advanced techniques there's one about ratio married put collars, ratio married puts using the collar spread, that reverse collar spread, which makes it a bear call spread, and also discusses a little bit about the conversions as well. So there is a lot of information in there. And if you're interested in a more protective strategy, a more conservative strategy with a lot more income methods, Uder, I'm going to recommend you go buy the blueprint, okay, by Kurt Frankenberg, because that is a more designated position where you open up with limited risk and unlimited upside profit potential. But at the same time, you have 10 income methods. And Kurt, what he does sometimes is when he does one of his income methods and generates a credit, he'll start buying shares of stock. Okay? He'll start buying shares of stock. You fall more into the aggressive category? I see, Uder. You'd be surprised at how many aggressive positions Kurt got into, even though I'm touting his methodology as a conservative form, because it really is. But he's been able to make large profits on things like RIM, Green Mountain Coffee Roasters, and some other positions, while always having a small risk of single digits. But yeah, you're doing it more aggressively that way. More power to you. There are some discussions in the Protective Options Strategies book that revolve around that. And again, I mean, it's $19.95. It's only $20. It's not an expensive book. And in addition to offering information that we've discussed about in the last 2 weeks about what kind of criteria to look for, what things you may or may not want to be aware of, things that you may or may not be aware of, I should say, and some of those advanced strategies we mentioned, it's all right there in the book, okay, in the Protective Options Strategies book. But I really recommend that if you're looking for good protection and you want to play aggressive, you like to make multiple trades on it, that radioactive trading method uses the 10 income methods in a variety of forms off of that married put there. All right. Well, I went over time. I did apologize for that. I'm sorry, ladies and gentlemen. I wanted to try and keep it short, and we didn't get to go over some of those other longer-term positions when you're looking at an extended column that's between the strike prices or when it's below the strike prices. If you want some of that extra synopsis I was going to go through on that, just send me an email. Maybe I'll try to put something together over the weekend for you guys. But they're the same kind of techniques. It's the same techniques, but you just have that further out in time put. All right. Okay. Well, I thank you all for joining me, ladies and gentlemen. Remember, if you have any questions at any time, send us an email to support@powerup.com. You can call us toll-free during market hours at 877-992-7971. That's if you live inside the continental U.S. Or 302-992-7971 if you live outside the continental U.S. There's also contact links at every page. Remember, we're going to have, this is recorded, okay? We archived the first one. We're going to archive this one too. This particular recording probably won't be up in the Power Options archive in the Learning Center until maybe Monday. But we will be archiving this. So you'll be able to check that out. And next week, I believe, next week we're going to start, same time, Thursday, 6 p.m., I think we're going to potentially start with the credit spread discussion. So even though we touched on credit spreads as a parity trade to these callers and short callers, we're going to do a similar 2-week presentation starting next week, Thursday at 6, on credit and debit spreads. I should just say vertical spreads. I apologize for that. And as well as the second presentation the week after that would be on some management concepts. All right? Well, thank you again for joining us. We look forward to seeing you at a future webinar here at Power Options during our learning season. Have a good night, everyone. I really hope everyone has a great expiration tomorrow and all your trades for this month worked out really well. And if you have questions before you roll a position tomorrow, hey, send me an email, give me a call. You know I'll be here all day tomorrow too. All right, take care, everyone. Have a good evening.